Hello, everyone, and welcome to The Buck Stops Here. I'm Catherine Murray. Well, I think, as you know, my program is focused on bringing you context around the content that impacts your business, the markets, and your money. In other words, really trying to make sense of the various factors affecting our lives and our opportunities. I think, as many of you also know, I spent 14 years on Wall Street at Goldman Sachs as well as Deutsche Bank before having an 11-year career on business television. So before we get to our main conversation today, I thought it might be good to give you a little bit of a market recap, given the dramatic sell-off we've been seeing in the markets, which are down by about 20% over the past number of weeks. We did actually see the Dow drop 1,100 points this week in one day, actually, driven by inflation fears. And, you know, we know inflation's out there. We know that it's at a multi-decade high, over 8% in the United States. But what really spooked investors this week, and maybe what turned the tables a little bit, is that we are actually now seeing inflation affect companies. You're seeing that in the earnings, Walmart and Target this week. That was the key driver to the downside. Target shares were actually down by 24% following their first quarter earnings results. And they reported earnings that missed expectations as well as margins well below expectations. And the company actually warned of a bigger margin hit this year due to rising fuel and freight costs. We also saw a big hit to Walmart after cutting its annual profit, again, due to these rising costs. Walmart, in fact, had its worst daily stock performance since 1987. And these are two big retailers. Obviously, their stocks don't move to the degree we saw them move this week. So it really was a bit of a spook. We have seen trillions of dollars wiped out of the global markets in recent weeks, as I mentioned. Investors are selling their high valuation stocks. Remember, as rates rise, that does put downward pressure on valuations, and tech valuations are among the highest. In fact, the Wall Street Journal has an article out saying a handful of these stocks are responsible for 46% of the S&P 500 2022 losses through Wednesday of this week. Again, investors are seeing and selling in anticipation of the U.S. Federal Reserve having to be perhaps more aggressive in raising rates to combat inflation. I would, however, suggest a very out of consensus call to think about that we are actually seeing a slowdown in U.S. economic data quite dramatically. In other words, the economy might in fact be operating at a slower rate and slower pace, which is less inflationary and might in fact mean that the U.S. Federal Reserve doesn't have to be as aggressive at raising rates. Now, of course, we have two exogenous factors impacting inflation, that, of course, being the war in Ukraine, affecting food supply, and also, of course, oil supply. Those two factors are not going away. So maybe we will have to see the U.S. Federal Reserve continue to raise rates. Today, we look to be getting a bit of a bounce in the market. It's Friday, I always pre-tape. And that is because China had a surprise rate cut in order to boost their economy. This is another important dynamic because when you have two of the largest economies in the world, the United States as well as China, with opposing central bank policies, the U.S. raising rates to combat inflation, China lowering rates to spur growth, that puts upward pressure on the U.S. dollar. It's very painful for emerging markets. The big question is, can the U.S. Fed continue to do that, put upward pressure on the U.S. dollar? Because in addition to focusing on inflation, they also want to maintain financial stability. And when you have a rising U.S. dollar putting so much pressure on emerging markets, that could create financial instability. So just something to think about. We'll watch how the markets react today for sure. And you can always watch my market recap on the News Forum every Thursday. Let me bring in our first guest. We only have a little bit in this segment, but Barry Fenton is the president and CEO of Lanterra, focused on real estate here in Canada. Barry, great to have you with us. Just quickly before we do take a quick break. What are your thoughts right now in terms of the rise in rate and inflation environment?
Well, inflation isn't a good word for me, but what ends up happening with inflation issues is that we end up having to pass out those inflationary rates over to consumers. So that does become a problem. The other issue for us is when you have trades locked in to build high-rise condominium projects and inflation hits. Some of the trades may try to come back and crawl back and or come back to us and ask for increases contract amounts. But overall, we've been able to deal with it. And my own feeling on inflation is that I think it's going to be shorter lived than people are talking about. And I think we'll look back and say that it wasn't a great period of time for inflation, but we'll fix it.
We are back with Barry Fenton. And Barry, I was so serious at the beginning in terms of just kind of getting the market views out, because it has really, I think, shaken people, particularly this week. So I forgot to say welcome. And to our viewers, we have been talking, you and I, for so many years now, and you're one of my most favorite people to interview. So thank you for being here.
Thank you. My pleasure, and always thank you for having me. And you're one talented host, so I appreciate the opportunity. So thank you.
Thank you. So let's get back to a little bit of the business here at hand. And we were talking about inflation and how that impacts you in the interest rate environment. Maybe just give us a little bit more granularity. I mean, because we're seeing this, everybody's feeling this, that someone feels the pricing pressure, so they're raising their prices. Tradespeople are going to raise their prices. I mean, it feels like it's never ending.
Well, at the end of the day, I'm involved in a company that builds substantial infrastructure of high-rise and mid-rise and low-rise condominium projects throughout Canada, and we're also doing a lot of activity in New York. So it's housing. So when you have inflationary issues, what gets affected is the interest rate component of when purchasers are going out to lock in mortgage financing when they close their transaction, and also the costing of the commodities themselves. So it can affect and will affect, but at the end of the day, it gets most of those costs will get passed over to the purchasers. I mean, we, from a profitability standpoint, we've locked in the ability to sell inventory 2, 3, 4 years ago on some projects, and now we have a commitment which we follow through on to deliver the product. So our profitabilities may be affected by that. There's no question about it. We're very transparent about it. But at the end of the day, I think inflation is going to be curtailed, and I see that interest rates, I believe, will be coming down as well.
What kind of upward pricing pressure are you seeing? And I think people are really trying to understand, like, why and how is this happening? I mean, we know COVID, we know that's impacted supply chains. Now we've got the war in Ukraine. But what are you seeing? Why is this happening? Where are the stress points, Barry? Just so we really kind of understand it.
Well, I don't want to say that inflation is fixed, but I have this funny feeling that a lot of what's going on now are people taking advantage, and I don't want to be disrespectful about it, but I think that inflation is the talk of the month, the flavor of the month, and I think between wars and reasons to increase interest rates and softening in some of the markets. And the truth of it is, a lot of people have extra money lying around just because of the fact that they weren't spending it over COVID. So I think now, you're seeing people have access to a lot of extra cash, and they're not quite sure what to do with it. So that's one of the reasons why we have an inflation problem. But I think overall, again, as I said before, I think the inflation will soften, and I think will continue to go on. But from a real estate standpoint, I think that the markets are substantially in good shape.
And so, why do you see that and say that? And I think everybody, most people's main asset is actually in real estate. Why are you so confident about the real estate market? And we're in Canada, but obviously all of our markets are so interconnected, particularly from a rate perspective. But real estate in Canada, particularly Toronto, Ontario, and surrounding regions, why are you so confident?
I think that first of all, I think that money has never been as easy to obtain, and when you look at how people finance projects, most people go out and they get theirs. They go to the CIBCs and the Scotiabanks, and they're able to obtain first time or second time financing against the property. So that's number one. And number two, I just think that the market in general has a lot of ability to go out and add strength.
So how much of a factor, though, when we think about what's even going on from an economic perspective or wage inflation, Many people will point to the fact that we haven't had immigration for 2.5 years. How do you see that impacting real estate?
Well, I think, you're absolutely correct. And in fact, we have rental buildings downtown Toronto where, we couldn't rent a unit for 9 months because they were student occupied. But what we've seen in the last 3 months is a fury of backtracking and of people coming back to Toronto and to Canada on the immigration standpoint. So again, everything kind of came to a halt between COVID and inflation and a lot of other things, but it's turning around very, very quickly.
Okay, we'll take a quick break. A lot to catch up on when we return. We'll be right back.
Thank you.
Barry, it's interesting to see and really hear from your viewpoint that we are seeing people come back to Canada from an immigration perspective. How that's great and fascinating to hear, because that does put an upward momentum in terms of economic growth, I would think. What exactly are you seeing?
Well, there's no question that we were projecting something like 100,000 people moving into Canada from outside of Canada. We're projecting this year we're going to have something like 300,000 people coming back in. So we for the last 2 years, because of COVID, we just had a miss on the numbers. But we just think that's going to add fuel to the fire. I think it's going to put a lot of pressure, to be quite frank, on the rental markets, which will actually help the investment of real estate if someone is buying it as an investment. So, and I've seen that in the last 4 to 5 months. I've seen the rental rates go from approximately $3.50 a square foot downtown Toronto to something like $5 a foot. So, so there's no question that immigration helps. Canada also, as a country, is the second safest country in the world. It's looked at as the top 3 countries in the world. The currency, which I can never figure out, is Canadian dollar to the U.S. is trading at roughly $1.30. I think it's way undervalued compared to where it should be. So I just think it's a good story, and immigration, there's no question, helps create more wealth for owners of real estate assets in Canada, and it also provides vibrancy and economic stability for Canada as a whole, not just the real estate game.
And our viewers should understand that you invest in Canada and the United States. You can do it wherever you want. From a real estate investment perspective in Canada, what specifically interests you right now?
Well, we continue to invest in condominium high-rise projects and mid-rise. We also have gone out and looked very closely at the office market. We think that that market had some hurt in the last 12 to 24 months. So we're actually really eyeing some really cool assets in Canada on an acquisition basis. And in New York, we have a very, very large, substantial rental project that we actually commenced, and then we put it on the back burners because of what was going on with the COVID situation. And it's actually interesting that now that we're back and we're going to commence construction shortly on about a 700,000 square foot site in New Jersey by Journal Square, and the rental market has gone up 30% from when we were going to start to where we are now. Now, granted, it's going to take 4 years to build a project, but it just, like, COVID was a bad thing, but on the other hand, it's actually helped the stability of the project on the other side. So hopefully I've answered your question with respect.
Well, you did. So a couple questions. You're looking at offices in Toronto.
Well, we're looking at, that's one, we're looking at a class of real estate that got really beaten down, and people are trying to not understand how to deal with it. I mean, we continue to also stay tuned to our own asset class, which is
Yeah.
which is condominium high-rise living in downtown Toronto, and there's just so much more demand for it now than there was before. So we're not going to, we're going to stay tuned to where we are, but the other market that I just talked about has a lot of potential, I believe, the office component. And we, in fact, have acquired a few buildings over the last few years and the last, months to add to our portfolio.
So we're going to go back to work in an office. I love it.
I think we're going to go back to work. I'm not sure I'd want to be an owner of a restaurant in the food court, but I think the rental rates are going to go up, and I think that there is going to be a demand for people to come back, and I think that when people come back, they'll want to have more space per person as opposed to less. So there's going to be a demand for more space usage, and in fact, we have a very large portfolio in downtown Toronto that we just renegotiated a 400,000 square foot lease, which wasn't technically supposed to be negotiated for another 3 years, and it was a substantial commitment by a very, very large company for the next 20 years. So that was actually very interesting to me. That was a good sign.
Yeah, it's a great sign. Also interesting to see that, people want to return to the cities. That's a change. We're going to take a quick break. We'll be right back. Barry, you and I have been talking for so many years now, and every year the real estate market goes higher and higher. And I think I was always asking you, can it really continue to go higher? So where do you think now, at the point we're at, where do you see real estate the next 3 to 4 years out as an asset class?
I think it's going to continue to shine. I think that value. I think that if you buy something today and you buy it in the right location and you buy it properly, I think you can see 30-40% appreciations. I mean, I think that when you look at 12 years ago, if you were buying an asset, you were spending $1 million. Today, it's probably worth 2.5. So yeah, I think that the real estate game is here for the long haul. It's for sure something a little more safe, in my opinion, than buying the stock market index at way high and then it recorrects 20% or 30%. You don't see that in real estate. You actually don't. The only thing that you may see is a 3 to 5% correction, but in Canada we haven't seen that. In New York, we saw that for maybe 6 months, where you saw a 20% decrease in condominium product, and then now it's not only did it catch up on the 20%, it's back up another 20%. So, and Miami's another perfect example. I mean, that whole market is on fire. So, I mean, real estate, everybody should have that in their basket of stability and how to create wealth. No, there's no question that people, are entitled to do other investments, but the real estate market, I believe, has so much more substantial in the long run, and will continue to do well. And I think that the rental market will help. I think interest rates are going to come back down, which will fuel it again. I just think there's a lack of supply and there's just so much demand. And in our business, which is the condominium side, we've really taught the industry over the last 20 years that it's a class that people can live in and deal with. So it's I think we're in really, really good shape. I'm not ready to retire yet, but I think we're almost there.
And Barry, when you say, buy it in the right areas, what do you think is an interesting area these days?
Well, I like the, it's interesting. We just, we're very successful in a 1 million square foot launch for the viewers in the west end of the city, where there's going to be new transportation created thanks to the Ford government. And, you're able to buy product there probably for 2/3 of what you would pay for in downtown Toronto. And I think that over the next 5 years, that valuation will be similar to where downtown Toronto is now. So I think there's no question it's more affordable. It's interesting too, because people aren't buying larger units because it's more affordable. People are all happy to buy the same type of square footage. But so that's one marketplace. Another marketplace we're very heavily loaded up with Cadillac Fairview in areas by the shops at Don Mills. But generally speaking, I think that the downtown marketplace still has so much upside as well. There's just so much good infrastructure downtown Toronto.
And, I think you mentioned about 4 years ago, we were seeing some of these sales at $1,200 per square foot, which seemed unbelievable at the time. What are you seeing now?
Well, we've just come out with some new launches downtown in the theater district area, entertainment area, and we're launching at $1,700-$1,800 a square foot. So, but the truth of it is, you need to do that from our standpoint because costs have gone up, land prices in order to acquire the assets have gone up, and we need to make sure that we carry enough contingencies in the project to deal with, as we're seeing now, in inflationary pressures on commodity prices. And for example, in Toronto now, they just completed another strike. The union just had a substantial strike and shut down all of the projects throughout Toronto. And now at least they were able to settle. But the average labor is now going to get an increase of $10 or $12 an hour over the next 3 years. So everything adds up. So the formulation has to be from an investor standpoint or purchaser standpoint. You need to buy it right. You need to be prepared to sit with it, but you'll do really, really well.
Real quick, are the banks still willing lenders?
Banks have been incredible. We have strong relationships. We have billions of dollars out with the banks right now, but they're very supportive. They understand the game. The banks have, in their pie-shaped classifications, real estate is probably their number one asset that they want to continue to hold. And thanks to the banks, the top 5 banks, they've been tremendous to us at Lanterra, and we appreciate it.
Okay. Barry, we got to leave it there. Great to see you. Thank you.
Thank you for having me.